There are calls this morning for the government to adopt a spending constraint in this year's federal budget. According to Nine newspapers, some economists believe Labor's budget should be contractionary and take money out of the economy in a bid to help the RBA maintain its inflation target. This quarter's inflation figures are expected to be around the 3.5% mark. That could see the RBA hold off on an interest rate cut until early next year. I feel like that's becoming more and more likely. Joining us live now, HSBC Chief Economist Paul Bloxham. Paul, you've been ahead of the field on this one when it comes to rate cuts. But first, where do you think those figures are going to land today?
Oh, I think the inflation numbers are going to give us some good news and some bad news. The good news is going to be that, of course, inflation is still expected to continue to come down. So it was 4.1% last quarter, and we think it's going to be 3.5% this quarter. That's the good news. Inflation's coming down, and that's a good thing for households in particular. But that's not low enough, and that's the bad news. Inflation is still above the Reserve Bank's target. The Reserve Bank target's 2 to 3% inflation, means they're looking to get it sustainably to 2.5%. So it means, I think, where we are is still inflation is still too high, and the RBA really can't consider rate cuts anytime soon.
So at what figure would they consider cuts? Would it have to go underneath 2% for that to happen?
Well, the key is that they believe, based on what's going on with the whole economy, the labour market, the jobs figures, as well as the growth numbers and the inflation story, that inflation will get back sustainably to their 2.5% target. So they've got to believe that. And at the moment, we've got an economy where the labour market is still actually quite tight. The unemployment rate is still quite low. Wages growth is still quite strong. As we know, house prices are rising. There are lots of signs in the economy that inflation might not fall that much further from here particularly quickly, that it might take time, quite a bit of time, for inflation to get back to the RBA's 2.5%.
Sorry, Paul. Yeah, so it's like that final part is the hardest to achieve.
That's right. So we're in the last mile, as economists have been describing it, and that last mile might take a while. It might be the hardest bit to get inflation down. And the key here, I think, in relation to budget, of course, is if the budget comes out and puts more money into the economy and stimulates growth at this point in the cycle, it's possible that it might put upward pressure on inflation. Inflation might fall more slowly. And then that fits together with our view. We don't think that rate cuts are likely this year. We think rate cuts are a more likely proposition for 2025.
Yeah. Start of next year, or are we looking deeper into next year? I mean, you've got to factor in house prices to all of this as well. That ain't cooling at all.
Well, we think that the RBA will have the option to be able to start easing policy from the beginning of next year, but that certainly the market's been moving into pricing that sort of view. But a lot of the discussion has still been about rate cuts this year.
Yeah.
We think rate cuts are more likely in 2025.
The other thing around the corner, Paul, is that everyone, as we know, gets tax cut from July 1. So there'll be more money going into the system. What's that going to do to figures?
Well, that we think will actually support consumer spending, as you're describing. It makes sense if households get more income back and they have the available income to spend. And we think that will support consumer demand and likely put a bit of upward pressure on inflation, mean that inflation, although, as I said at the beginning, is coming down, It's not coming down quite fast enough. It's not yet at the RBA's target. And a bit more stimulus at this point in the cycle might mean it'll take even longer for it to come down, leaving the RBA with few options to cut.
Okay, that's not good news for those with mortgages this morning. Paul, appreciate your time, though. Good to chat as always.